Welcome to the Pro Tickers Deep Dive, your go-to breakdown of the stock movers and major stories at the close of global trading. Let's dive into today's market action. Today, we're really dissecting a market tapestry woven from, well, unexpected natural disasters, high-stakes geopolitical maneuvers, and some truly unconventional corporate decisions. Our mission, as always, is to cut through the noise, connect the dots, and sort of reveal the deeper implications for your portfolio and, your understanding of the financial world.
It's certainly been a day that reminds us how interconnected global events are, often in, well, surprising ways. We start today with some truly heartbreaking news on the domestic front, specifically severe flash flooding in central Texas. This catastrophe, triggered by an extreme weather event on July 4th, saw 4 months' worth of rainfall in just a few hours. The human cost has been immense. At least 82 people confirmed dead, and tragically dozens more are still missing.
Absolutely devastating, just awful news. And the immediate human tragedy is paramount, of course, but this kind of event will undoubtedly have a ripple effect that extends far beyond those immediate heartbreaking statistics. What are we seeing in terms of the broader impacts there?
You're right to point out those broader implications. Beyond the profound personal losses, the economic reverberations of this Central Texas flooding event are really just beginning to surface. We're talking about potentially multi-billion-dollar impacts when you consider the scope of insurance claims for damaged homes and businesses, the immense costs of infrastructure reconstruction, roads, bridges, power grids, and the significant disruption to local supply chains.
Oh,
Multi-billion. Yeah. And meteorologists are also warning that ongoing storms could worsen these already hazardous conditions, further complicating recovery efforts. Eyewitnesses described a 2-story wall of water swooping through low-lying areas, leading to severe destruction and prompting extended flash flood warnings across several Texas counties.
just incredible.
It really is. And among the hardest-hit locations was a summer camp, where at least 10 children and a counselor remain unaccounted for, intensifying search and rescue efforts. Local authorities have pledged to continue these efforts until every missing person is found, and a federal disaster declaration has already been issued to mobilize additional resources for the affected region. It's a stark reminder that even, geographically isolated natural disasters can quickly escalate into material financial risks, prompting crucial discussions on climate resilience in investment strategies.
That puts so much into perspective, really does. And it highlights how quickly unexpected events can impact communities and, well, the broader economy. And unfortunately, that wasn't the only domestic headline today that could ripple through the market. We've also been tracking the ongoing sanitation worker strike in a major northeastern city. This is significantly impacting waste collection, creating not just a public health issue, but also, an eyesore, especially problematic during this extreme heat wave we're experiencing.
Not good timing.
Not at all. Think about the potential for business disruption, public sentiment, even health costs if this isn't resolved soon. And then, completely unrelated, but just as sudden, an explosion at a strip mall in the western U.S. injured 3 people and completely destroyed a business. This triggered a major emergency response and, again, is another localized event with potential economic fallout for that community, impacting small businesses and potentially real estate values.
Yeah, each of these domestic incidents, though distinct, contributes to a kind of mosaic of local uncertainties that investors are trying to factor in, even as we look at the bigger global picture.
Right. And speaking of that global picture, let's unpack a monumental shift brewing on the international front, because there's big news coming out of the U.S. administration. They are signaling new trade tariffs. It appears they are preparing to reintroduce sweeping tariffs as a 90-day pause expires. We're expecting dozens of nations to receive formal notices or negotiate bilateral deals before these new rates take effect on August 1st.
August 1st, okay.
But here's where it gets really interesting. A new aggressive 10% tariff is being threatened against countries aligning with anti-American economic policies. This explicitly includes nations supporting alternative global trade currencies and those with, growing geopolitical influence that's perceived as adversarial.
This is a truly significant development. I mean, directly impacting global trade dynamics and potentially reshaping supply chains for years to come. What's fascinating here is the specific targeting of a coalition of emerging market nations that this new tariff threat implicates. This group recently met to express criticism of Western actions in the Middle East, though no formal collective response to this tariff threat has been issued from them yet. It's a delicate diplomatic and economic tightrope.
Very delicate.
However, there is a notable exception to this general tension. A prominent South Asian economy, which is a key member of this very coalition, is reportedly close to finalizing a framework agreement with the U.S. to avoid these penalties. If successful, this could set an interesting precedent, demonstrating that bilateral negotiations can potentially carve out exceptions even amidst broader trade disputes. Or, well, it could create fissures within that emerging market bloc.
It definitely shows the nuanced dance happening on the global stage. And speaking of delicate geopolitical balances amidst these mounting global tensions, we are seeing renewed diplomatic efforts underway in the Middle East.
That's right. Delegations are currently meeting in the Gulf region, hoping to broker a ceasefire in the ongoing conflict. There's a glimmer of hope. Officials from the U.S. have expressed cautious optimism, suggesting that a potential agreement involving the release of hostages could actually be reached within the week.
Within the week? That's fast.
It would be. This is a critical development for regional stability and, by extension, global markets. However, it's not without its contradictions. This cautious optimism contrasts sharply with ongoing military escalations in surrounding areas, including fresh maritime security incidents and airstrikes, which continue to raise concerns about broader regional instability and the potential for the conflict to, spill over. It's a very complex situation with multiple moving parts simultaneously.
So a mix of hope and ongoing tension there, reflecting the complexities the markets are constantly trying to digest. Given all of this, particularly the Middle East developments and the broader trade discussions, how are energy markets responding? We often see immediate reactions in oil prices to these kinds of headlines.
You'd expect volatility, wouldn't you? But interestingly, global oil prices moved only slightly today, despite an unexpected production increase by a major energy consortium. This group, which typically exerts significant control over global supply, announced plans to boost output by more than 500,000 barrels per day.
500,000 barrels, wow.
Yeah. Their stated reasoning is in anticipation of rising summer demand, fueled by increased travel and economic activity. While such a surge could potentially flood the market and drive prices down, we saw a remarkable stability. This suggests underlying demand is stronger than anticipated, perhaps fueled by the start of the summer driving season, or that global inventories are tighter than previously reported, creating a cushion for this additional supply. It's a subtle but important signal of economic resilience amidst geopolitical noise, indicating that the market has a healthier appetite for supply than some might have predicted.
That's a good sign, yeah, indicating some underlying stability despite the volatility elsewhere. Okay, now, switching gears to corporate news, we saw a high-profile tech company's shares slide significantly today. They dropped nearly 7% in pre-market trading, and the cause? Well, it was news that its CEO is forming a new political party.
A new political party?
Yeah.
Seriously?
Seriously. This announcement, coupled with broader uncertainty around new trade and tax policy, drew a lot of criticism from political figures and analysts who are really questioning the strategic rationale behind such an unconventional move.
That's certainly an unconventional move for a CEO, I'll say. And the market clearly reacted to what it perceives as an unprecedented level of risk. This isn't just a bizarre headline. It's like a seismic event for corporate governance. When a CEO, especially of a high-profile tech company, decides to launch a new political party, it fundamentally blurs the lines between their fiduciary duty to shareholders and their personal political ambitions.
Absolutely.
So investors are now grappling with questions of potential distraction from core business operations, the risk of alienating customers or employees who don't align with the CEO's political views, and the unpredictable impact of new political ventures on the company's brand and regulatory environment. It sets an almost unprecedented precedent for how much personal conviction can intersect with and potentially overshadow corporate strategy, leading to that significant pre-market slide.
That is an absolutely fascinating intersection of business and politics, definitely one to watch. But on a more straightforwardly positive note for the tech sector, there's a promising trade deal in the works for a very popular social media app.
Indeed. U.S. and Chinese officials are reportedly nearing a deal involving this widely used platform, a development that's been eagerly awaited by investors. The proposed solution involves the platform developing a new, distinct version specifically for American users, with an expected launch timeframe by September.
By September, okay.
Yeah, this agreement could finally resolve the ongoing national security concerns that have threatened to ban the app domestically, which has been a major cloud hanging over its valuation. It's a pragmatic approach, really, to a complex geopolitical tech issue, aiming to safeguard data and national interests while allowing the platform to continue operating in a critical market. This provides much-needed clarity for its massive user base and, of course, a huge relief for the company itself, unlocking significant potential.
That certainly clears up a major hurdle and provides a clear path forward for that company. Good news there. And finally, after the holiday break, U.S. markets reopened today at record levels. Investors are keeping a very close eye on several key areas right now. Specifically, ongoing trade developments, the minutes from the Federal Reserve, and the upcoming earnings reports. Each of these carries significant weight for market direction.
A strong start after the holiday, definitely, with markets digesting a lot of nuanced information, but plenty of factors still in play, as you rightly pointed out. Those Federal Reserve minutes, for instance, offer a granular, almost word-for-word account of the central bank's latest policy meeting, providing crucial clues on their outlook for inflation, employment, and future interest rate adjustments. They can shift market expectations dramatically. If we connect this to the bigger picture, analysts are currently forecasting a modest 5% earnings growth overall for the upcoming season, with the technology and artificial intelligence sectors expected to lead the way, continuing their strong performance. It suggests cautious optimism, but also maybe a concentration of growth in specific areas. And just as a quick additional headline from the world of international sports, a controversial late goal gave a North American team a dramatic loss in a major soccer tournament final.
Ouch. A tough one for them.
Yeah, tough one for the fans, but thankfully, that impact is largely confined to the sports pages and won't be moving any major market indices today.
That wraps up our deep dive into today's market movers and key financial stories. We've covered everything from tragic natural disasters and their economic ripples to the intricacies of global trade negotiations, surprising corporate decisions that challenge traditional governance, and the overall pulse of the markets as we head into the second half of the year. Understanding these interconnected events and truly grasping their deeper implications is crucial for anyone navigating the financial landscape.
Thanks for listening, and we'll see you next time on the Pro Tickers Deep Dive. Stay sharp and stay informed.